In the early years of the 20th century, the American economy appeared to be expanding at a breakneck pace. But beneath the surface of this booming market, invisible fractures were growing. Unlike European nations, the United States operated without a central banking system to manage its money supply during a crisis. The flow of cash was tightly bound to the agricultural seasons, tightening every autumn as funds were sent westward to purchase the harvest. In New York City, a new type of financial institution was rapidly gaining popularity: the trust company. These trusts were originally designed to manage estates, but they had evolved into aggressive competitors to traditional commercial banks. They operated in a regulatory gray area, unburdened by the strict cash reserve requirements that traditional banks were forced to follow. By keeping far less cash on hand, trust companies could offer highly attractive interest rates to draw in everyday depositors. But this money did not sit quietly in a vault. It was aggressively funneled into the stock market. Trust companies provided massive, uncollateralized overnight loans to stockbrokers, fueling a speculative frenzy on Wall Street. It was a financial house of cards, built on the dangerous assumption that the market would always rise, and that depositors would never ask for their money all at once. The system looked incredibly promising to the ordinary person, but it was highly vulnerable to a sudden shock. That shock arrived in October of 1907, sparked by unregulated ambition. A wealthy copper magnate named Augustus Hines had recently relocated to New York, where he partnered with Charles Morse, a banker with a notorious reputation for aggressive speculation. Together, they devised a high-stakes scheme to corner the market on the stock of the United Copper Company. They believed they could quietly buy up enough shares to trap short sellers, forcing those sellers to buy the borrowed stock back at artificially inflated prices. To fund this massive gamble, they relied on their vast network of banking connections. But the financial market is deeply unpredictable. When they triggered their trap on October 15th, the scheme failed spectacularly. The targeted short sellers easily found shares from other sources, and the price of United Copper plummeted from nearly $60 to just $10 in a matter of days. The speculators were financially ruined. In a more stable environment, the failure of two men might have ended there. But Hines and Morse were not isolated players. They sat on the boards of multiple banks and trust companies across the city. Their reputations were now completely toxic, and the public quickly realized that their deposited savings were tied to the very men who had just lost a fortune. Fear is the ultimate contagion in finance. As news of the failed copper corner spread, a slow dread transformed into a full-scale panic. Depositors rushed to withdraw their money from any institution remotely associated with Hines and Morse. While traditional banks managed to survive the initial wave through the organized help of the New York Clearing House, the loosely regulated trust companies were left entirely exposed. The public's panic soon zeroed in on the Knickerbocker Trust Company, the city's third-largest trust, led by a known associate of the speculators. When rival banks publicly refused to act as a clearinghouse for Knickerbocker, the public's confidence was shattered. Thousands of desperate citizens crowded the sidewalks, begging for the return of their life savings. Police were called in to control the chaos as tellers handed out millions of dollars in a frantic, losing battle. Within a few short hours, the Knickerbocker was drained dry and forced to lock its doors and suspend operations. The collapse of this massive institution unleashed terror across the nation. Trust companies everywhere faced unrelenting lines of terrified depositors. The lifeblood of the stock market instantly froze, with interest rates for emergency broker loans skyrocketing to 70, and then to over 100%. The stock exchange was on the verge of total collapse, and ordinary people watched helplessly as their financial security evaporated. With no government central bank to step in, the survival of the American economy fell heavily onto the shoulders of one man, the formidable private financier J.P. Morgan. Recognizing that a total systemic collapse would destroy his own empire alongside the nation's, Morgan immediately organized an unprecedented private rescue mission. He summoned the city's most powerful bankers to his home, deploying teams to audit the failing trusts and injecting millions of dollars in emergency loans to keep the stock exchange from shutting down. But the crisis kept mutating. By early November, a major Wall Street brokerage firm was on the brink of failure, threatening to drag the remaining trust companies down with it. In a legendary display of brute financial force, Morgan called the city's top bank presidents to his private library on a Saturday night. When the men could not agree on how to fund a bailout plan, Morgan simply locked the library doors and put the key in his pocket. For hours, the exhausted bankers argued in the opulent room, trapped by the most powerful man on Wall Street. Finally, at nearly 5 a.m, broken by fatigue and Morgan's relentless pressure, they surrendered and signed a $25 million agreement to save the system. The following day, Morgan finalized a massive corporate buyout to rescue the failing brokerage, securing emergency approval from President Theodore Roosevelt just moments before the opening bell. The midnight deals worked, and the panic eventually subsided, but the damage was profound. The contagion of 1907 triggered a severe economic contraction across the United States. Industrial production plummeted, businesses declared bankruptcy, and millions of ordinary workers lost their jobs as unemployment surged. While J.P. Morgan was briefly hailed as a hero, public gratitude quickly turned to profound outrage. Citizens and politicians alike were horrified that the survival of the American economy had been held hostage, reliant entirely on the mercy and deep pockets of a single private banker. A congressional investigation soon exposed the immense concentration of wealth and power held by Wall Street's elite, fueling a nationwide demand for structural reform. The nightmare of 1907 became the ultimate cautionary tale, proving unequivocally that a modern economy could not survive without a dedicated safety net. This realization sparked years of intense legislative debate, eventually culminating in the creation of the Federal Reserve System in 1913. The United States finally had a decentralized central bank to act as a permanent lender of last resort. Today, the panic of 1907 remains a stark historical reminder. When a financial system outgrows its own safeguards, fueled by unregulated ambition and hidden risks, the eventual collapse will spare no one.